Hi everyone, welcome to our latest Artemis Live video. Today I'm delighted to be joined by Sidney Rostan, who's the head of ILS at SCOR Investment Partners. Now, SCOR Investment Partners is the asset management company of global reinsurance company SCOR Group, and has had some success in the insurance-linked securities space this year as well as in previous years, and has recently lifted its ILS assets up to around 2.4 billion, which I believe is roughly a 10% increase in 2020. So it was good to get Sidney to agree to come on to talk. SCOR Investment Partners has had a particular focus on the industry loss warranty in recent months, I believe. And so we thought it'd be interesting to talk about a different area of the market that doesn't always get as much coverage, perhaps. So Sidney, thank you for joining us.
Yeah, hi Steve, many thanks for your invitation. So obviously, you know, when you look at building ILS portfolios, when you look at getting involved in the ILS world, the two cornerstones are cat bonds on one hand, the liquid part of our market, and let's say the private UNL space on the other hand. But there is another market segment in between, in a way, which is the IW market. It's a far smaller market. Obviously, it's $5 to $6 billion. And it's been often described, you know, as an opportunistic only market, you know, to be used by protection buyers as a fallback solution in a way, when you struggle placing your retro program, for example, or to be considered only after the retro program is placed or after your cat bond is placed. So a resource that can be used only as a fallback in a way. It is the case, honestly, it is the case, but it's not only that. We've been able to build relationship in that market. So we've been active in that market for many years now, and we've seen the landscape obviously change in terms of who's buying, who's selling protection. We've seen people come in, people come out. But at the same time, we do have long-standing relationship with a number of counterparties, and that's really interesting. It's like in the CRI market, you can build long-term relationships, and we're renewing, you know, some IW structures for the fifth or the sixth time, exactly like in the CRI market. And we can even, in some cases, you know, renew some packages involving several structures on a tailor-made basis. So that's really interesting, and that comes down to one of the first interesting features of IWs. I believe it's a flexibility feature. When we think a little bit, obviously, an IW is basically the only product which is not syndicated. Is the only product which allows you to generate your own investment opportunity in a way. Unlike cat bonds, you know, or unlike the vast majority of CRIs, the deal is not a take it or leave it type of situation based on existing conditions, existing FOTs in the CRI market, for example. You can build your own structure. You can imagine that you have an existing portfolio and you want to design the perfect additional investment really fitting your portfolio, enhancing the diversification and the risk-adjusted return, for example. So you can design that structure and try to place it and try to find the exact matching interest. So that's a theoretical thing. In real life, it's potentially a little bit more complicated. You simply get out to brokers and try to find the matching interest. It's not always the case. And you start negotiating, you know, the terms and conditions, the price, the structure. It takes 1 or 2 weeks, maybe in some cases, but you usually end up with the structure you're looking for, or a structure which is really close enough to still make a lot of sense from a portfolio construction perspective. So that's really very, very interesting. And we have a vast variety of structures in that market. Obviously, we can invest in occurrence versus aggregate structures. Second event IWs are pretty interesting from, you know, a diversification standpoint in terms of event sequencing. It makes a lot of sense in our view. We also can build, you know, aggregate structure with a cap by event. We can also look at windows types of structures, seasonal structures, regional structures, you know. So there's a lot of flexibility. And obviously, you can be long and short in that market, which is the only one which offers that feature. So a lot of flexibility there, and as well a lot of flexibility when you renew the transaction. And obviously, collateral trapping has been a very a major topic in the market. At least from our experience, we've always had sound discussions on the few transactions we had which could have been trapped. Sound discussion leading to a satisfactory outcome for both parties, avoiding collateral being trapped, i.e. rolling the collateral into the next renewal period. So we've really had a positive experience there. So the flexibility is really one important feature. I can think about another important thing is transparency. Honestly, in today's market, after all what we have experienced, after the loss creep, after all these concerns we've had post events, I think transparency is really very, very important. And in the IW world, you simply have clarity on what you get exposed to, which perils, which are defined, clearly defined and limited, which territories, which business line, you know what's covered, what's excluded. And that has a lot of value added. On top of that, you basically have a pretty quick initial estimate, so it's a few weeks, depending on the type of event, depending if it's in the US or in Europe, but it's always pretty quick, and you know when you're going to have updates of the estimate. So you have more transparency and clarity there. So I would tend to think that IWs are, on average, let's say in a way, a bit less offering room for bad surprises. In a way, at the end of the day, you have less modeling risks. You potentially have a little bit less room for loss creep. We've seen loss creep, on Irma, for example, but maybe a little bit less on average in the market at industry level than on an individual basis on UNL transactions. So this has a lot of value for us because when it's a transparent product and product which you understand well, which you can value better after an event, you can build a more standard and more systematic valuation process around industry loss figures. You are more transparent to your investors, you are more accurate, and you're more quick in reporting the situation to the investors. And that's absolutely crucial in today's market context. Yeah. The third advantage is liquidity or liquidity management. Obviously, an IW is not a liquid product. It's a 6 to 12 months private transaction with no liquidity. It can be trapped. So per se, it's not a liquid product. But the IW market is open the whole year long, basically. It's not only tradable on the big, CRI renewal dates, January 1st, June 1st. We can trade around this date as well. And from a liquidity perspective, it is simply potentially improving the liquidity profile of your fund, of your strategy during the year. And depending on the level of liquidity you want to offer your investors, it can be really important in that respect as well. So these are some of the advantages we see. Obviously, an IW is not a perfect product. It is transparent, but we can still have bad surprises there. But we are in a slightly better position, I think, compared to some other types of investments. Even a parametric transaction is not necessarily ideal as well. You may remember the periods of uncertainty we've had on some parametric cat bonds post-event after the Tohoku earthquake in 2011, or I can remind of Patricia in Mexico as well, which have all hit parametric cat bonds, and it was not working as well as one could have expected. So there is no perfect product in the market. Obviously, there are some pros and cons for every product, but in our view, it may make sense to have blended strategies, being able to invest in all market segments, to make the best out of what the market can offer at any point in place. And if you are agile enough, and if you have dry powder enough at one point in time, you can obviously adjust the balance between cat bonds, IW, CRIs, retro versus reinsurance, proportional versus non-proportional. And that makes a lot of sense globally to us, but that is including IWs as well in our view. The last point is pricing. Pricing is obviously also obviously a very important thing to discuss. From a pricing perspective, the market has often been considered as not being really attractive from a multiple point of view, from a risk return point of view compared to UNL opportunities. That's true in many occasions, but not necessarily all the time. The dynamic of the IW market is not necessarily exactly the same as the CRI or the cat bond market. We've seen that, for example, I remember that at the end of 2017, after HIM, when there were big wildfires in California in October and November, there was a real stress about the capacity shortage at year-end renewals. And we really see distressed buyers in the ILW market coming and ready to pay higher spreads. And that was before December, before everyone started to understand that we were in a great reload phase, with a lot of capital flying into the market. And at the end of the day, there was no repricing on January 1st renewals and no repricing in the cat bond market. But we were able to crystallize for a 12-month period, because we were up and running at that point in time, higher returns in that market segment. So you see how that can make sense. Again, pricing can be a little bit more aggressive, but if we factor in all the soft factors, all the qualitative aspects I was mentioning, transparency, flexibility, liquidity, it can make sense from a portfolio construction point of view. Sorry, I've been really long, but I thought it interesting a bit of time on that market.
That's very interesting. Thank you. Yeah, I mean, the ILW market is a really interesting segment because it's in some quarters it's often been looked at as sort of the poor cousin of the rest of ILS, and something that's always been much smaller and struggled to grow. But actually, it plays a really important piece of people's hedging programs. And you explained well there how it can be both a strategic asset as well as something speculative that you can pick up at different times of the year and respond to your clients' needs as well. So a lot of positive features, but are there any negatives that investors should be aware of when it comes to the ILW?
Yeah. Again, ILW is not the perfect product. There are also some drawbacks. So liquidity is the first drawback. Honestly, it's not a liquid product per se. The size of the market is also, a negative point, I think, and it's very much US centric, like the cat bond space in a way. Even though we find opportunities outside the US, especially in Europe, and then there is another aspect that you have to rely on a limited number of data providers. They have performed really well, I think, in the last few years. We can also always complain about, the loss creep, but I think overall they have delivered. But one thing is sure, you have to be cautious on data reliability, which means look at how the data collection process is going on. What is the market share in terms of data collection? If there is enough track record in terms of back testing with past events. So we have to be really careful about that in that market.
Yeah, and the quality of the data is obviously all important, but to some degree they're reliant on quality of data from the cedents coming through as well, aren't they? So it's not the easiest job to report on industry events, especially with the complexity of some of the major events we have seen in recent years. So what are you seeing in recent months in the ILW market in terms of how risks are traded? And I guess as the reinsurance market in general is hardening, and retro in particular is potentially showing a bit of a sort of lack of capacity for year end. Do you think this is really positive time to be in ILWs?
Yeah, it probably is. It may well be at the end of this year in particular. So we've seen some interesting developments in the ILW space in terms of terms and conditions. That the first positive thing. It is obviously related to the hardening of the market. As always, the dynamic is not only on the evolution of the prices of the gross rate on lines, like we call them in the ILW market, but as well on terms and conditions which can be negotiated depending on where you are in the market cycle, in the softening or the hardening market. So on the ILW side, what we've seen in recent months is a switch from any natural peril to name storms and earthquake. In order to be in a clear defined environment, even though again in the ILW space we have a defined and limited list of perils which are covered. But one never knows. It's better to be on a defined peril list. So there is no more, at least on our side, including but not limited to, type of language, which obviously opens the door for bad surprises potentially, like a pandemic, for example. So this is a very interesting evolution. From a structural point of view, obviously second event ILWs have shifted a lot in terms of what the market standard is in terms of triggers. We were really focusing on second event 5 billion, 7.5 billion, or 10 billion type of structures. We now are looking at 10 billion, 15 billion, or even 20 billion second event structures. That's where the market is, when the heart of the market is. In terms of aggregate structures as well, we've seen a shift from 3 billion to 5 billion per event deductible to a 5 billion to 10 billion per event deductible. So this is obviously all meant to purify to some extent the exposure. In more recent time, we've obviously seen some systematic inclusion of a communicable disease exclusion. That's very important as well, obviously in today's market. So that's from a transaction point of view. From a market point of view, we've seen interesting evolution as well. We've seen market initiatives aiming at bringing more people in the ILW market, aiming at increasing the fluidity of the market, so in marketplaces in a way, or aiming at increasing the liquidity of the ILW market, i.e. transforming an ILW into notes. We see this development very positively, obviously. We hope that these developments will bring more market participants and increase the market size ultimately. From a broader basis, market conditions, we're obviously in a hardening market. That's not new. We totally second what's being said here and there in the market. We see that in all market segments, basically. So we've seen the cat bond market reprice in April, May and June. We've had a lot of primary market activity, and deal after deal, it confirms really the repricing, the 100, 125 basis points repricing. We've seen that in the ILW market. I was mentioning some windows of opportunities for a hardening period, which can be as short as 1 or 2 months, like in 2017. We've seen a little bit the same thing in April and May, ahead of the June 1st renewals, with distressed buyers, looking at reloading protection, and they were ready to pay very interesting increases in terms of rate on lines. It has come down a little bit. It has come down again a little bit. In the cat bond space, we've seen, after the very active primary market in May, June, we've seen during the summer and since then more buyers in the market. So that has driven prices a little bit up again. So that was a kind of a recovery. So the increase in prices that we have experienced this summer, so it's not only the seasonality, I think it's as well more buyers around. So does it mean that the hardening is not going on? I don't think so, really. When we look at the first, cat bonds, which have been launched in very recent weeks, and if we look at the way that they have just closed or they are currently placed, we see that one thing, there is I think a lot of cash around, at least a lot of cash to be invested in the cat bond space. You've discussed several times already, about the shift between more risky or retro types of strategy to cat bond types of strategy, more liquid strategies, and strategies which have performed better in recent years as well. So we were seeing cash around, but we see as well still some discipline, investor discipline, and that's really, really good news. We've seen that before the summer. You may remember that some transactions or some layers of some cat bonds transactions have been pulled because of a lack of investor appetite. We believe we are still in the same situation. So really, at the end of the day, a hardening market, higher spreads, significantly higher spreads than pre-COVID-19. In the CRI space, it's obviously a bit too early to say and to speculate about January 1st renewals. But when we look at interest starting to materialize on the ILW side very early in the process, we can really assume that there will be some capital being lost and trapped in the retro market this year again, another round of capacity shortage, and this is obviously going to drive returns up in the retro market, in the reinsurance market as well. It's really difficult to say to which extent. It's going to be 10%, 20%. It's going to depend on the structures, aggregate structure, which will once again reprice more than occurrence. The repricing will not be exactly the same across the board between, you know, structures which have been hit in recent years and structures which have not been hit at all in recent years. But yeah, an overall market hardening, more investor discipline in the visible part of the market, which we can observe, so i.e. the cat bond market. So a pretty good environment for us. There is still a lot of uncertainty, honestly, on the COVID-19 side. I think the worst case scenario is less and less probable. You know, the scenario of general, you know, rewriting of contracts. So that is out of scope, I would think, at the moment. But still, we're seeing a second wave materializing in many countries. We see that the legal environment surrounding commercial BI in particular is still evolving. We've seen that in the UK, you know, with the English High Court judgment based on the FCA test case on a number of different contract wordings, which were in favor of insurers more than in favor of insurance companies. So the situation is still evolving. On the CRI side, we see information pop up and more precise information on the various reinsurance programs we participate in. The situation is very, very different from one ceding company to the other, from one country to the other. So COVID-19 is going to be a big event. If we look only at the commercial BI aspect, it's gonna create some losses in the traditional industry. Obviously, the ILS market is gonna take its share of the loss. Not really in the cat bond space, except, you know, the IBRD pandemic bond, which was really a bond. It's not a surprise. It's been a bond which has been structured and designed to cover such type of events. But apart from this loss, I don't see any other cat bond being hit. So, but there will be more impact on the UNL side, as always, in a way, on the retro market or on the proportional business. So, and that is obviously as well contributing to the capital shortage. Yeah, one other important thing we were watching, obviously, like every year, but maybe even more importantly this year, is the situation around the seasonal risk, hurricane, typhoon risk, after all the events we've experienced in recent years. So obviously this year has been really an amazing hurricane season. 25 tropical storms, 9 hurricanes, 5 hurricanes making landfall in the US. Yeah. We've had a lot of wildfires as well, but in both cases, the good news, if we can find good news there, is that we haven't had any major events so far at least. So we're getting close to the end of the hurricane season and the typhoon season. We still have to be cautious. We are still really within the wildfire season, so the situation is evolving, but I would say in a way so far so good. We haven't had any category 5 hurricane, for example, and that's important in my view. It simply means that global warming, which is obviously one very big topic in the market as well, doesn't necessarily mean that we're going to be hit. The market is going to be hit by very severe events every year. That's a very positive signal. So I think that's really important when we discuss with our investor base, to be able to demonstrate that, okay, global warming is there. It has an impact. The hurricane season was supposed to be very active. It has been very active. It doesn't necessarily mean that we're going to have huge losses. So obviously Laura is a medium-sized event, let's say. It's supposed to be less than 10 billion. Sally and Delta are supposed to be less than 5 billion. So we've had events, but not big ones. Sure. There has been not so much impact on the market, on the cat bond market. It is putting some pressure on aggregate structures. Yeah. In the cat bond market, we see the few cat bonds which have been marked down, which have been under pressure in recent weeks. So there has been an impact, but overall, no major hit to the industry, no major hit on the cat bond side during that summer. It's the first time in 3-4 years that we have not had any impact. So this year, finally, at least, we were able collectively as an industry, and the vast majority of ILS managers were able to report positive and good returns in August and September. And that is as well a positive signal we're sending to the outside world.
Absolutely. It's a good signal to send through to the investor base at this time. And I suppose with the you explained how terms and conditions are changing and being adjusted and being tightened up on a lot of structures, particularly around aggregates and things like that.
Yes.
The cat bond market in particular, the return potential going forwards looks to be improved even on how it was last year or the year before, which I guess it's a sign of the hardening again, but also a sign of the market perhaps learning from what's been before and absorbing the effects of the losses of recent years and coming out with structures that perhaps work better for cedents as well as for investors.
Yeah, you're right. You're right. We've seen investor discipline. You know, we've seen a pushback when the transactions were too aggressively priced and or structured. We are seeing again, I would say, a more significant price differential between occurrence and aggregate structures, which is a healthy way to look at things, which was no more the case 3-4 years ago, to be honest with you. So no, it's a positive development and it's a healthy situation we believe we are in the market at the moment.
And so what's your outlook on sort of 2021? What's your expectation in terms of market conditions and potential for investor inflows, I guess, as well? And whether the appetite is going to be there, because obviously there's been quite a discussion of investor appetites having been changed by the pandemic and the volatility in the marketplace, but obviously that's subsiding a little now. Could we see a good growth opportunity potentially for ILS into 2021?
Yeah, I think so. I definitely think so. I think the outcome of the COVID-19 sequence is pretty positive for the ILS market. It's shown its decorrelation benefit once again. It has shown that it is a resilient market. And honestly, when we discuss with our investor base or with prospects, when we mentioned that the max drawdown, you know, during the whole crisis was -2%, and it was only a mark-to-market effect, you know, related to the selling flows we all know from multi-strategy funds, you know, they're really impressed. You know, it's far below the volatility they have experienced on all of the other markets. And we regularly said that the ILS holding was not at all the big concern on their end this year. So I think it's a positive feature that the ILS market has been able to demonstrate again. Obviously, investors have been cautious in recent months. And it's logical, I would say, because of uncertainties surrounding, you know, the COVID-19 crisis. If we remember the situation in which we were in before the summer, it is really understandable. We on top of that, we were having you know, a forecast of a very active hurricane season, so it was not really the perfect timing to get involved or to top up in the asset class. So we now have far less volatility and uncertainty in the market, I would say, going forward. As I was mentioning, the hurricane, typhoon season, all the seasonal risks so far have been pretty okay, I would say. So far so good in terms of the overall market performance for many players. So we believe that there will be again investor appetite by the end of this year and into 2021. On our side, we're seeing again some traction and some very interesting discussions and the pipeline of potential inflows building up again.
Good. That's good to hear. I guess finally, maybe if I could ask you to think about what the last sort of 3 or so years, the challenges the industry has faced, and sort of what you've learned at SCOR Investment Partners from this, and how this has changed your approach to ILS investing going forward. Yeah,
we've gone through so many things in the last 3-4 years. It's amazing, new perils popping up. The initial shock, you know, the loss creep, which was far less understood by investors. The trapped collateral issue. So it's been a test for everyone, honestly. We believe we have rather been positively tested. At least our fund's performance has been as expected in a way, given the magnitude of the events we had to face. So we've seen that more the validation of what we do. but we have at the same time learned a lot of lessons. You know, we have to humbly look at things, try to understand what's going on, trying to understand the evolution of the market, of the climate, of a lot of things which are important for us. I can imagine 2 or 3 things when we mention lessons learned in a way, or ways we improved in our way to manage our ILS portfolios. I think the first thing is selectivity. We are all selective in a way or another. We all have preferences in what we want to do, and aggregates is a point of attention, really. So clustering, event sequencing is something which is not new at all. We all know about that, but you know, what's happened in the last 3 years has really demonstrated how much pressure we can have on all potential aggregate structures, or proportional business, which is a kind of aggregate structure as well, you know. So we've always been cautious on aggregate structures and selective. We've always been underweighted, to be honest with you, on aggregate structures. If we compare the proportion of aggregate structures in our fund versus the cat bond market, for example, we're even more selective on everything which is, you know, top and drop or cascading, all the aggressively structured aggregate structures. I totally understand. It's a perfect match, you know, for seasons. It is part of the game, you know. But we try not to be too much involved in that part of the market, and we stay away from any aggregate structure with no per event deductible, for example. So that's first thing. The second thing I can think about is global warming. Global warming is a concern. It is in all discussions we have with investors and prospects. It is a complex topic. Obviously, the most straightforward answer to that concern is that models are taking that into account in a forward-looking approach. Models are evolving, constantly evolving. On top of that, the market is evolving. That's the beauty of the reinsurance market. It is repricing constantly, you know, based on new information, on new losses. We believe at SCOR Investment Partners that it's not enough. It's true, but it's not enough. It's partly true, but it's not enough. We want to proactively manage the changes we face. And everywhere where we believe that there is a clear demonstration of a link between global warming and an increase of the risk level or the uncertainty around a certain peril, like wildfires, for example, or flooding related to hurricanes, we de-risk the portfolio. Right. We de-risk the portfolio. You know, on hurricanes, there is a real debate. Are we going to see more frequency and or more severity on hurricanes going forward? Obviously, the last few years have been showing indications in terms of increase of both frequency and severity. We really believe that obviously warmer sea surface temperatures on average are going to cause more severe hurricanes if all conditions are met, you know, conducive conditions, low wind shear, all these things. We have the potential for bigger and more severe and more destructive and costly hurricanes at the end of the day. So we've de-risked the portfolio in that respect, trying to improve the shock absorption capacity against hurricanes, for example. And the last thing, if I may, is one very important topic for us is the qualitative aspects of what we do. We all run models in our industry all the time in all possible ways. We all build our own models on top of the industry-wide, you know, used models we all know, to try to get the best vision possible of any investment opportunity we are looking at. That's very, very important, obviously. But on top of that, I think that the qualitative aspects are very important. I'm personally weighting qualitative aspects as much as quantitative aspects. It means that the structural features of transaction, I was mentioning the type of trigger before already, but also, you know, the variable reset features. You know, if you don't pay too much attention on that, you can have a great distortion of your portfolio over time, you know, because of variable resets. So that is something we pay a lot of attention to, the potential for an early redemption event, for example, depending on the valuation of a cat bond at one point in time. So all these soft factors we try to factor in. When it comes to UNL investments, there are a lot of different potential issues we face. So the alignment of interest is really crucial. it leads us to decline some investment opportunities only on that topic. Obviously, the quality of the ceding in a way is very important. We've developed a scoring methodology on cedents, which is, among other factors, taking into account their demonstrated ability to report quickly and accurately on their own losses. We've all been tested as ILS managers, but cedents have been tested as well, and we've seen huge differences, in that respect, and we factor that in. By the way, we are in the process of adding an ESG component to the scoring. We're working closely together with our sustainability officer. So the qualitative aspects are very, very important. Information we have on all potential investments are crucial as well. Transparency, reliability, granularity of the information we are shown on any UNL position. That's really important because, again, we want to be transparent. We want to be quick to react. We want to be accurate towards our investors. We owe them this, yeah, that really leads a change in our way to invest. And at the end of the day, very important things we discuss very regularly and questions we have to answer is that, what's your position in terms of tracking share side pockets? What's your position in terms of trapped collateral at the moment? And what's your residual exposure, i.e. potential negative impact in terms of performance coming from past events? And the more transparency you have in your underlying portfolios, the more you're comfortable in your ability to value them as accurately as possible at any point in time, following more or less any type of loss scenario is really crucial to us. And that, at the end of the day, it allows us to improve the returns, the stream of returns of our funds, trying to be as regular as possible, trying to be showing as less volatility as possible. In a word, be as resilient as possible in that environment. And that's what I think what investors are looking for.
Sure. That was a really great summary, Sidney. It brings together a lot of themes that we've been covering lately about sort of the focus on terms and conditions and how that actually can help to improve your return streams just as much as rate in this environment. So I think that's a message that investors are looking to hear from investment managers. So well done on that. And certainly it sounds like SCOR Investment Partners is taking the learnings forwards to try and build better portfolios for your partners. So thank you very much for your time today. I really appreciate it. It was great to talk with you. Great to hear your insights on the marketplace and on ILWs in particular, Sidney.
Thank you very much, Steve.
Thank you. I'll talk to you soon.
Bye-bye.